Welcome to Manifested Publishers.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Emlyn Ngwiri and we are discussing about portfolio management. The focus of today's class is on introduction to portfolio risk and return. So what we're going to do, we're going to narrow down that discussion to assess the determinants of required rates of return. Now the determinants of required rates of return can be broken down into three. The first determinant of rate of return is the time value of money. The second determinant of the rate of return is expected level of inflation. The third and final determinant of required rate of return is the risk itself. So we are going to break down or try to understand how those factors influence the required rate of return and also investment decisions for investors. So we move over on this other side and start off our class. We mentioned that investors' required rate of return, investors' required rate of return, investors' required rate of return is one of the factors to consider, is one of the factors to consider when selecting securities for an investment portfolio. Securities for an investment portfolio. We continue and say it is the minimum required rate of return that an investor would actually require so that they can be compensated for deferring the usage of funds today. So we say that it is the minimum. It is the minimum rate of return. Rate of return is the minimum rate of return an investor should accept. An investor should accept. Minimum rate of return that an investor should accept from an investment in order. From an investment in order to compensate them for deferring consumption. From deferring consumption. So let's just recap what we've just written. Investors' required rate of return is one of the factors to consider when selecting securities for an investment portfolio. It is the minimum rate of return an investor should accept from an investment in order to compensate them from deferring consumption. So now since we've already now explained or introduced what the investor's required rate of return is all about, we now start by assessing the components. The first component that I had mentioned to you, number one, is time value of money. Time value of money. That's the first determinant that an investor should consider before investing or making an investment decision. So we say that the value of the sum of money at a future date that has been that has been invested at a certain rate, that has been invested at a certain rate of compound interest, certain rate of compound interest over a certain period of time, over a certain period of time. We'll stop. Let's stop there. We are saying that TVM, time value of money, is the value of the sum of money at a future date that has been invested at a certain rate of compound interest over a certain period of time. A shilling today is not what it was a shilling, say, 10 years ago. So that is that concept of time value of money. Very important determinant for required rates of return. Investors therefore prefer to receive money more sooner than later. Why? Because investors can reinvest those funds or those proceeds they've actually received at a different at a different rate of return. So we can say that investors, we move over on this other side, prefer to receive money sooner rather than later. The reason being is that receiving money sooner can allow them to reinvest at prevailing rates of return so that they can be able to earn inflows as opposed to waiting to earn it much later on. The second determinant of required rate of return, very important, is number two, expected inflation. Expected inflation. This is the rise and fall of the level of purchasing power, or the purchasing power, whether it actually increases or decreases. When inflation levels actually go down, or when the inflation is, say, manageable or slightly low, it means that what you can buy with 100 shillings or 1,000 shillings is going to be much more as compared to when the inflation levels are actually high. This is an important factor to consider. How much money you'll actually receive. Will it have a higher purchasing power or will it have a lower purchasing power? So we say that the rise and fall of inflation, must be included in any calculation in order to reflect the value of the investment, the value of an investment, value of an investment at a later date, Rise in prices, a rise in prices of general price of commodities leads to lower spending power, leads to lower spending power, and vice versa. So we note that the rise and fall of inflation must be included in any calculation in order to reflect the value of an investment at a later date. Nominal value, the real value. The real value factors in that element of inflation. A rise in prices of commodities leads to lower spending power. That is the second most important determinant of the required rate of return. The third one, ladies and gentlemen, is risk. Risk. Risk factors, we can say, risk factors may vary. Risk factors may vary from instrument to instrument. From instrument to instrument. Instrument to instrument. Risk of investing risk of investing in a venture capital firm might be high, but the expected returns from that investment need to compensate the investor for deferring the usage of funds today to place to make an investment or that investment in that risky venture. So we can say that the risk of investing in a venture capital firm, please note that a venture capital firm is considered to be maybe a firm that has just begun and that is actually considered to be, say, a startup, not a startup from the grass. So we are saying that it's like, so there at this level, it's moved from that level over there to this level over here, and in terms of the assets or in terms of say the size of the company has moved from that smaller level to this one. So this is what we're considering a venture capital firm over here, or we can be able to say a venture capital firm is generally like considered to be a startup there. So the risk of investing in a venture capital firm is high, but returns should compensate. Returns should compensate. Returns should compensate for the higher risk taken, compensate for the risk taken. Risk taken right there. So we are saying that risk factors may vary from instrument to instrument, or from investment to investment, or from asset class to asset class. The risk of investing in a venture capital firm is high, but the returns generated from that investment should compensate for the risk taken, right there. And this brings us to the end of this subsection that we are talking about determinants of required rates of return. Three major ones, and the first one is the time value of money. The second one we've already discussed over here is the expected level of inflation, and the third one is risk. As usual, I will leave you an assignment. So come over on this other side. Explain giving or citing examples, the determinants of required rates of return. The determinants of required rates of return. Required rates of return. That is the assignment that I have for you today. We hope you've enjoyed this class. Thank you and be blessed.
Welcome to Manifested Publishers,